All right. So mic's on, we're good. So thanks everybody for making your way downstairs, and thanks again to the host for putting on a really fantastic event. My name is Scott Sigel. I'm with Arwen. I want to talk a little bit about non-custodial trading, specifically within a centralized exchange. Now, this is going to be a little bit less technical than some of the other chats you're hearing today, but I think it's important we talk about traction, how we talk about attracting more capital, and how we're really getting the institutional market to come in and start playing in crypto. So, unfortunately, this is probably stuff that you've seen way too often or way too used to it, and it's probably become normalized in terms of how many times we hear about yet another exchange hack, or something that's gone offline, or another exit scam. And while we're out building these really fantastic trustless protocols, the fact is, as humans, we still need to have confidence and trust in underlying systems that we're interacting with. And every time another one of these hits the market, it's just taking the institutional players away. It's highlighting how nascent our industry is. And we really need to start to think about how we move beyond this from an infrastructure perspective. Unfortunately, 2019 hasn't fared too much better, as just about every single month, we're still seeing more news hitting the wire about another exchange hack, another exit scam, not to mention the largest exchange by volume also having similar issues. So again, we still have this issue with eroding trust and significant counterparty risk for institutional players to start to play on these exchanges. So why are we not hearing news about the last hack on the New York Stock Exchange, or why is there not news about NASDAQ having some exit scam? And I think everybody in this room pretty much knows these places, these venues don't hold custody of assets. And institutions are comfortable with the segregation of custody and trading and investment. They have been segregated for years, and it's how institutional players play in the space. Now, I won't go into too much about how much we still have issues with kind of our existing custodial solutions. And for those of you who don't follow Caitlin Long and haven't heard her chats on rehypothecation of assets, check it out. It's fantastic. There's a lot of things that are still broken with the system, but the fact is we still need to solve our custody problem with exchanges. So what happened to blockchain? I thought this whole technology was going to solve all of our problems and get rid of this hyper-centralized, rigged system that was made for the 1%ers, and how are we going to kind of decentralize? And we're still kind of in the process of working this out, but let's talk about what we've done with blockchain so far. Now, DEXs conceptually are fantastic. It gives the user ability to maintain custody. You could transact peer-to-peer. But the problem is DEXs still don't have the scale. They don't have liquidity. They don't have the volume. They're subject to front running. So while there's still a future where, at least for me personally and a lot of people on the Arwen team, we do believe that there is a future where DEXs do find scale, right now it's not there. And the fact is, sorry, the numbers are a little small here, you can see the market's basically voted. When it comes to liquidity versus security, the market has chosen liquidity not even close here. I mean, we're literally talking about a fraction of overall traded volumes right now. Less than 1% are on decentralized exchanges. So it really still is around. The early adopters, the true believers, like everybody here in the room, we're all trying out DEXs because it goes back to the core principles of blockchain. But the fact is, you've got, again, the issues of slippage, front running, infrastructure problems that are just not solved yet. And truthfully, institutional players are not ready to start transacting on DEXs. If they do, for testing purposes, but we're just not there yet. So we haven't totally seeded the security argument yet. In fact, over the last few years during, we talk about crypto winter and building, there has been significant growth in custodial solutions. Even if you look at, the sales on the retail numbers, the growth on the third-party custody side, or anything that's for the institutional market, we've seen new entrants, we've seen great traction, and you've seen legacy players like Fidelity getting into the space in custody. So it's still absolutely a concern for institutional players who want to maintain strong custody and have strong protections, but how do we start to extend that beyond the wallet? How do we take this fantastic gated community, if you will, and start to open up the gates and not be subject to theft and dangers that the institutional players, the endowment funds, the pension funds are going to be very concerned about? So again, best custodians still can protect you while you trade. So how do institutional investors think about this now? And the answer is they're pricing in the risk. They're expecting that something might happen. They're selective about the exchanges they trade on. We'll hear things like, look at the Bitwise report. And they'll go to the ones that are more trusted. So we're still following a traditional financial template of trusted parties. We're not using the blockchain for all the things that it could be used for. So if you think about, you've got X amount of principal, and as a institutional fund, you're going to spread some smaller amount of that across exchanges. And again, it might be the Coinbases, the Polos, the Krakens, the Binance, and they're only going to deploy some amount of active capital, and they'll leave those on the exchange, and let's try that. And if something goes down, if there's an issue, they might be out that 4% of their principal, but when you're up 20, 30%, as far as they're concerned, that's fine. That happens. It's the cost of doing business, whether you're a high-risk hedge fund, certain market makers. This is just part of the process right now. We're just kind of allowing it to be from an institutional perspective. And this is just as true, not even just in terms of hacks, but anything around infrastructure risk, counterparty risk, in terms of clearing and settlement, where how are you guaranteed as an institution that you're going to have efficient access to capital? If you need to move, when you think about opportunity cost, moving off one exchange to deploy on another, do you have immediate access to those funds? How long do you have to wait? How much do you have to factor in that risk? And again, while the the high risk appetite investors, traders are going to come in and they're happy to play, we're not going to get the larger sources of capital, and the larger institutions just are not going to be cool with this kind of setup. So institutions really want the best of both worlds. They want a little bit of central, they want a little bit of decentral, they want fast trade execution, they want high levels of liquidity, they want to mitigate or eliminate that counterparty risk that's associated with centralized exchange trading, and they want that efficient access to capital. And that's really what we believe as a team that Arwen is. Now, while we're a team of cryptographers, network security, Sharon Goldberg, our CEO, has been doing network security and cryptography for years. We love the concepts around blockchain, but we're not pure decentralists right now. We're looking at this from a perspective of adoption, traction, and how do you start to really mature and grow the market. So that's exactly what we're doing. We're trying to combine the best of centralized solutions where you have access to high volume and high liquidity, but bring in those protections and those guarantees that you get in a DEX around self-custody. So we tie in with centralized exchanges by bringing in our own protocol that we wrote for interchain operability. Arwen extends the security beyond the custodian. It allows you to effectively use capital in a way that you're not concerned about the counterparty risk of trading on a centralized exchange. So whatever your custodial solution is, if you're a retail user on a Ledger or Trezor, if you're an institutional user on Coinbase Custody or Anchorage or Fidelity, idea that you can trade with an exchange without ever seeding out custody. We do this through a combination of a layer 2 atomic swap protocol and hash time lock contracts that sit on native blockchains. There's no Arwen coin, there's no Arwen blockchain. We want to use underlying blockchains for their security benefits that are not being fully employed to date. And that's, again, our mission. We are trustless interoperability for crypto trading. Our goal is focused on that institutional adoption, bringing more capital into the space, and allowing more activity and growth in the crypto ecosystem. Right now, we currently support Bitcoin, Bitcoin Cash, and Litecoin. We're in development on Ethereum and ERC20 for the next few months, and we're adding new exchanges and custodians in to make our system as seamless as possible. Think of us as pipes. We really want to be, we are building a standard for your ability to transact directly from your custodian into highly liquid markets. How Arwen works is, and I'll show you a demo in a moment, but effectively what you're doing is going to mirror what you would have with an exchange deposit anyway. Rather than moving coins out of your wallet into exchange custody, you're moving them into an on-blockchain contract. The blockchain itself is actually the agent of escrow. It is the security agent that provides security guarantees that are so much stronger than the encryption, 2FA, whatever else an exchange can guarantee. It's not at the same scale that a blockchain can provide you that security. So let me show you a little bit of a demo of Arwen is currently in beta on KuCoin. We're launching with a few new exchange partners coming soon that I'm looking forward to when we can disclose that. But right now, let me give you a little preview in what Arwen's all about. So let's maximize this. So this is live on mainnet right now. What I've first done on the left-hand side is we call these escrows. I'm depositing coins into an escrow directly from my wallet, very similar to how you would fund an exchange. All we need is an address. And again, this is a 2-of-2 multi-sig hash time lock contract, specifically between the user and the exchange. So while other atomic swap protocols you might be familiar with are more peer-to-peer, We built this with the idea that how do we align economic incentives? How do we make sure that you aren't griefed by a secondary party? And we actually use the exchange and their reputation to facilitate that. So on the left side here, we've got my Bitcoin that I deposited into KuCoin. So sorry, KuCoin is the exchange I'm trading on. However, those coins have been moved out of my wallet into a contract that's sitting on the Bitcoin blockchain. That's a layer 1 on-chain transaction to establish the contract first. On the other side, I asked the exchange to lock in some coins similarly on Bitcoin, so again, I might be buying Bitcoin for Bitcoin Cash, God forbid, but for the sake of the demonstration, the exchange is locking up coins I want to buy. Those can be pulled from their reserves, they can be pulled from a collateral provider. There's lots of really fantastic features we can do as far as staking options and ability to earn interest on your crypto as a collateral provider. But the idea is that the exchange is the one locking up the coins on the other side. Now, once both sides have confirmed on-chain, which, by the way, you're not signaling the market. These look like any other normal 2 of 2 multi-sig contracts. It's not necessarily looking that you're kind of front-running them. You're not front-running the market, but you're not sending any sort of market signals just by locking coins in contract. Now, the benefit of Arwen is all of these trades happen on layer 2. There is effectively the accounting for the contract on the user side and the exchange side tracked within the daemon that sits behind the app or an API that we also enable, and the exchange side. So every single time I make a trade, I'm changing the balances of those contracts, but not on chain. I'm able to trade fast, I'm able to trade securely, I'm able to transact with a centralized order book that's providing me pricing. So as an example, let's say I want to buy a little bit of Litecoin here. And I'll generate an estimate that's coming directly from the exchange. I request a formal quote. Again, all being piped in directly from the exchange. I place an order, and there we go. It's executed. So right now, this runs like an RFQ, which might be similar to like an electronic OTC for those of you who are familiar. We are currently building out market and limit order protocols for more high-frequency trading. Again, more institutional needs, but the idea is transact with a central order book, ability to maintain custody, trade secure, trade fast, and that's really the goal of Arwen. So to wrap up, we really believe that, again, if you think about that, institutions are going to be more comfortable segregating custody from trading, and in order to bring in more adoption, we need to start to think about how we disintermediate those. Now, there's a lot of other other non-custodial solutions that are entering the market, and these are also fantastic for institutional adoption, but the issue is so many of these are still built on trust platforms. They're still built on the concept of somebody else is either holding your keys or you have credit in exchange, not using the true potential of what blockchain actually promises us in terms of custody, in terms of guarantees, and using the decentral network for security. So the more we're able to actually employ the blockchain, not just for borderless currencies, not just for being uncensorable, but for its underlying security properties, that raises the value of the entire crypto ecosystem when you think about actually using the power of the blockchain. So while there are multiple ways to solve non-custodial, we're really excited about layer 2 atomic swaps with centralized exchanges. I think it's going to be great for the ecosystem. Again, I'm Scott Sigel from Arwen. Really happy to answer any questions, whether you're trading, custodian, exchange. Let me know. I'll be around, but thank you all for making time today.